I titled this presentation, Invent Your Future, because while we cannot completely predict the future, what we can do is we can make choices today in the present, just like Gandhi said, that actually produces a better outcome in the future. So we can invent your future by making great choices of the things we do today. So I want to start off with the difference between reality and truth, because I think this is happening right now all over the place. Most people have biases. Even I have my own biases. And one of my great friends who played as a center in the NBA once told me, he's like, "Aren't genetics a bitch?" Basically telling me because I was so short, I would never be able to play in the NBA. Now, of course, that is an inconvenient truth. But in some cases, many people would call it a reassuring lie if they believed that one day they would be able to do that. The truth is, my genetics prevented me from being an NBA athlete. The reason I tell you that story is because a lot of people are not paying attention to the facts of what's happening today, and they're stuck in their own software, in their own reality, and they're working through what I would call a reassuring lie. So you could actually apply this logic to your relationship, to your health, or even just to your financial statement. So let's take a look at the inconvenient truths. Inflation is the highest in 20 years. It hasn't been this high since 1990. Interest rates are also the highest in 20 years, which are in the early 2000s. Unemployment is at a 50-year all-time low, which hasn't been this low since 1969. Credit card debt is at an all-time high. We just hit $1 trillion. And personal savings is at an all-time low. These statements are the truth. Unfortunately, many people are looking at this and saying, I wonder what that's going to mean for me. They're stuck in these reassuring lies like inflation. How does that really affect me? Although they might be upset as their rent goes up, or the cost of food goes up, or the price of gas. They don't actually equate it to anything more than that. Interest rates will go down soon. We've all heard this. This is your typical syndicator or anybody that's hopeful is all hoping that interest rates will go down soon. Well, I hope so too. But the fact is, the Fed is just not positioned to do that over the next 18 months. Low unemployment is good for me. Well, it might be if you're an employee, but it's not if you're an employer, because wages are actually growing, which is inflationary, and the Fed is actually tackling that right now. They're actually predicting to increase employment by another 2 million people over the next year and a half. Your credit card debt, which is now probably paying at least 20%, means that you have to work more. More work, less time, more stress, more anxiety. Same thing with personal savings. As people are using their credit cards more, their personal savings is going down. They're also having to work more and more and make sacrifices on some of the things that they were doing freely just a couple of years ago. Some of you might have seen the analogy of the frog in the pot, where there's a frog in a pot of water and the temperature gets turned up. And eventually the frog dies because it doesn't notice the gradual temperature increases over a period of time. And that's exactly what's happening here. Most of these people are the frog in the pot. So what can we do in the present? Wages and fixed incomes are not going to keep up with inflation. So you're going to continue to get further eroded, and you're going to have to get that side hustle. 2, you're going to have to use low rate fixed debt to your advantage. Be the Fed. The Fed is going to continue to print. They're going to continue to raise interest rate. So you have to understand that this is happening and create a strategy to be on the other side of it, just like the Fed. 3, jobs will be lost and wages will slow down, which will reduce inflation, but it's going to create a lot of stress on the social services. We're going to see more and more unemployment. We're going to see rent controls and price controls as this gets worse. So this is a debt crisis. And so one of the biggest problems people are going to have is they need to pay off all debt over 8%, because the cost of debt is going to far exceed any wage growth that anybody has, and they're going to get further and further and further behind. And of course, unfortunately, personal savings will be further eroded due to continued inflation. If you think about it, if we have inflation at 4 to 6% in the next 10 years, which is entirely possible, then your dollar is going to be worth 50% less in 10 years. Or said another way, your buying power will be reduced by 50%. So now let's take a look at these charts. So the reason I picked this chart is because real estate exists where people go. It's much easier to go where people are going. What this represents are the top cities in the United States and where the population has migrated or trended over the last 12 months. So this is the net population change. As you can see, Dallas, Fort Worth, Houston, and Atlanta all are in the top 3. And the red dashes are the percent population change in Texas or non-Texas markets. The reason I picked this chart is because if you still want to invest in real estate, you should focus on where people are going, because that's where you're going to have rent growth, home price growth, and there's going to be all kinds of opportunities in these markets. As we all know, things have changed a lot in the last few years, but you can take an active role in your future and in your investment by concentrating on where people are going. Invest where people are going, work and live where people are going, and create new sources of income where people are going. It's really that simple. As many of you know, Dallas and Houston are 2 areas where we have been focusing on our acquisitions for multifamily. The second inconvenient truth, and on this chart, is what's going on with the office building market. So this chart is very interesting because what it shows is that many life, 401k, and pension funds are going to be in big trouble. This is a source of money that I use to go out and buy multifamily and office buildings and retail. As you can see here, the red line depicts the actual vacancy rate, and the blue are the total U.S. office square foot in millions by life company. What this means is that the valuations of these buildings that are held in these life policies are actually going to be devaluing over the next several years. These will eventually make it to your quarterly statement. And in the commercial real estate market, things are more expensive. More stimulus is going to be coming, and those on fixed incomes are going to continue to be stressed. The next inconvenient truth. So this is the biggest jump in office availability. Now, a lot of times you're going to find these vacancies all across America, but Seattle, Chicago, Boston, San Francisco, and Atlanta are the ones in the biggest trouble. What's important to note is that this is a year-over-year change. So Seattle has somewhere between a 7 and 8 million square foot difference in 1 year. So you've heard me talk about procession. This is processional, because these vacancies turn into non-payment of the loans, which turn into loan defaults. So commercial banks are going to continue to take on toxic commercial real estate debt. Property taxes are going to go up in these markets because downtowns are toast. Bank bailouts will be coming, which is, of course, going to create more inflation. And workforce participation is at an all-time low, almost a 2 million person difference. There's many predictions that say that commercial real estate, specifically office, is not going to come back till after 2040. So this, my friends, could be potentially a 20-year problem. And if there's no revenue in these downtown areas, things like property taxes are going to have to go up to support the services and the needs for those downtown areas. I love this chart because it's the passenger trips on public transit every single month. As you can see, it's way down. So it really dropped, of course, during COVID and the pandemic, but it continues to stay down. So what does all this mean? What it means is that this great resignation is here to stay. There's more jobs than there are people for those jobs. Work from home is not going anywhere, and the commute to and from work is more expensive. So this is a prediction that many of these downtown areas are going to continue to suffer. All the small retailers, all the small restaurants, all the small coffee shops. In addition to that, all the sales tax revenues from all the people, what they buy when they're there, of course, all evaporate and continue to put more and more pressure on these downtown areas. One of the things you might know from watching Dateline or some of these other crime stories is that when a cell phone pings, it's a data point. So these are percentages of cell phone activities in each city after COVID. What this means is that only a little over 25% of people are actually going back into San Francisco, and less than 50% in Philadelphia, Atlanta, Boston, etc. You get the point. So downtowns are toast. Revenues are going to be way down. Jobs, of course, are going to be relocated, and they already have been. Homelessness and crime will continue to grow up. So you see it now. You see these big homeless encampments. It's going to get worse, folks. There's going to be many political changes because it's going to have to get really bad before change is made. And of course, property taxes are going to have to go up to pay for all this. So the question is, what are you going to do about it? And how do you predict the future? How do you invent the future? Well, of course, it's what can I do in the present to take advantage of all of those things. So like I said in the last video, review your asset exposure like the banks. Sell off your marginal assets, your negative or no cash flow, even if it means to write a check. Fix your debt. You can hedge the up and refinance the down. Build your cash reserves. Cash is going to be king. It's going to be king for buying new properties. It's also going to be king for reserves for any financing that you need from your banks. Expect more stimulus and money debasement because banks are going to fail and there's going to be bail-ins, and there's going to be all kinds of money thrown at this problem, which is going to create more inflation. And then use inflation as your 2023 and 2024 strategy. Invest in things that move with inflation. Expect more loan defaults due to commercial real estate exposure, and expect more bank instability and failures because of the toxic debt and all of these issues. And more importantly, just be patient. Wait 1 to 2 years. Like anything, there's lag. You got to wait and then be in a position to strike. Buy low, sell high. It can be never more important than right now today.